more on investment, the language. Here's an important word: valuation. We're going to cover a lot of different things in this course, and one of them is trying to figure out the valuation, or how much it's worth. That plays a major role. You're going to look at the future cash flows. How much money will that company have actually in its own coffers? Sometimes a small company, this cash flow is a giant deal. If the cash flow, if you struggle with that, it's huge. During high inflation, you have to watch your cash burn. During really the aspect of a recession, you pay attention to your cash burn. You know what? General Motors doesn't have to worry as much about a cash burn as the local Joe and Frank's deli on the corner, because of the fact the size difference is there. So pay attention to future cash flows. It's always a big deal. And the timing as to when you're going to have changes in cash, and is it appropriate in the current economic times, and the amount. All those things, you have to pay attention to them. Sometimes on your own, do an individual activity. Look at 3 different investments. We just talked about doing 2. Look on 3. Which one of these would you prefer? Okay, you know these different aspects. One of them, you know the cash flow. Another one, the timing, you know when that's going to be, but you don't know how much, okay? And the last one, you know how much it's going to be, but you don't know when it's going to happen. All those may depend as to what you want to do. For example, investment A, you know there's going to be some future cash flows, but don't know the timing or the amount. It could be big, it could be small. Do you want to invest there, or would investment B be better if you knew when you can depend on money coming into the coffers because you need it to live on? That's a big deal. Or investment C, you know the amount, but really the timing doesn't matter because you have enough cash really to get by on a regular basis. You just want to have that amount, boom, have that over there. So that being said, pay attention to the different aspects as to what you can do. Risk and risk aversion. This is big. It depends what you want. You know, one of the textbooks that we have 2 of them, and one of them really is the one called the Intelligent Investor. That one, Warren Buffett recommends that as one of the best ones. You keep on seeing it all the time on list of different books that you should have for investment. It always shows up in the top 10, usually in the top 3. It's huge, but it's old. Regardless, they talk about the concept of a 10% mad money. Don't put any more than 10% or mad money out there into an investment, especially in areas like cryptocurrency. I went out and I bought cryptocurrency, and I'm still trying to recover my full principal I put out there because crypto plunged. As soon as I bought it, it seemed like they were planning on me to invest, and all of a sudden, boom, a month later, the whole market dropped out. They must have been waiting for me to show up, doesn't sit there and take my money. They did a good job of it. So risk averse is the degree to which you want to avoid risk. If you want to have a good diverse portfolio, you're going to take maybe 5 to 10% of your money and put it in some wild thing out there, because sometimes those wild deals really pay off. You may want to have some hyper conservative parts of your portfolio as well that is guaranteed by the government. Maybe have some government bonds, a treasury bill, or better yet, get something that's a little bit wild in the treasury, something like an agriculture bill. They pay about 1.5% more interest than a treasury bill. So look at that, that's solid financial security. Or maybe get a municipal bond. That's really different. So think about the aspect of what you have and what do you want? Do you want to be safe? Safe doesn't pay as much as wild and crazy. So it depends what you have, and you may want to have a mixture of the different ones, especially in the mutual fund market. You can pick and choose in the aspect of, I can have 17 different ones over here, boom, 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 and you have a whole 17 different range of risk aversion you can have there as well. And some of the high end will pay off and some won't, but you always have stable income. Pay attention to this on the risk. And really the investors, that we're all going to have different aspects of risk aversion. I may have one over here. You may not be comfortable with that. You may want to have something more conservative over here and make less money, and not be as crazy, because you may lose your shirt over here and maybe not. Or maybe you want to sit there and live on the edge of everything else and like, yes, I want my big thing in crypto. I want 20%. Yes, yes. And some people have done it and it really paid off. Or they put money into a Tesla stock and 3 years later, boom, they make $800,000. These differences can create a market for any kind of securities. One investor buys and another sells. Just depends what's out there. The return, the sum of the income plus capital gains. Capital gains can be a big deal, by the way. Income is cash flow from dividends and interest. Capital gains is an increase in the value of the asset. So income means you buy stock, you get a dividend. You buy a bond, you get the interest off of it. Capital gains is the overall asset. I bought this for $50 and now it's $150. Woohoo! I got $100 capital gains. The return is the income plus the sale price minus the purchase price. So pay attention. This is super simplistic, but it's how we base a lot of our investments on. How much is your return? That little formula, income plus sale price minus purchase price, is how the basic fundamental of what a return on an asset is. Percentage of return realized on an investment. If you put something out over there, that's a big deal. What is your percentage? Is it 12%? Is it 20%? Is it 30%? Your return may not get equal to the return you wanted. Sometimes you get more and sometimes you get less, or sometimes you get exactly what you want. So pay attention to that. Here's an example. You invest $100 in We Say So Corporation and hope to receive $2 in dividends and sell it for $105. Yes, $105, it's a $5 increase. That's a 5% increase plus $2. Overall, your whole thing is going to be 7% interest. Woohoo! Well, okay. Anyway, so when owning We Say So, it paid $3 in dividends and the stock sold for $103. Okay, so your rate of returns, you have $3 in dividends, which is really, if you look at it, a 50% bigger increase than you thought, but you only sold it for $3 more than you paid for it. So overall, you had a bigger rate of return on the aspect of the dividends, but you didn't sell for much. You had a 6% return. Sometimes you hope and you don't get what you want sometimes in the process. Uncertain future returns, Enron, $90.75 a share. And at the end of about a year, it was 26 cents. It's an oil company, and they had a thing called the Exxon Valdez. It hit shore and leaked. Billions of dollars later, unexpected gain. Amazon, 14% in one day. Yes, the Federal Trade Commission is going to get them for cornering the market. The dream of every entrepreneur. The Federal Trade Commission wants to get me because I have a corner on the market making billions of dollars. Yes, 14% one day. Those things happen. Sometimes you sit there and you're at home plate and you have a bat and somebody's pitching to you and you hit the ball out of the park. The one thing that Jeff Bezos did say, he says that whole aspect of being an entrepreneur or being an investor, the aspect of hitting a grand slam and getting 4 runs up one swing of the bat doesn't apply. Sometimes you swing that bat and you get 1,000 runs because you hit it perfectly. So the baseball analogy, not so much applied because the world of finances is very different than the world of sports. So risk, speculation, be careful on speculation. I was raised in a household where my dad bought options all the time. He just couldn't help himself. He was addicted to it. He'd make a killing one day and the next day he'd sit there and lose his shirt in the process, in the process. That wasn't very pretty, by the way. Anyway, so the risk implied a high degree of uncertainty. So be careful about the speculation. That's that 10% mad money in the process. So know the difference between investment, which is actually a planned overall return, and speculation. Yes, I'm gonna get it. Day traders are into speculation. Some of them are absolutely brilliant, and it's terrifying because they like to live on that roller coaster edge. You may want to try it as well. The stock market is not there to teach you. The stock market is there to exist, and if you don't pay attention, you will sit down and be penniless because of the fact that somebody else did your homework and you didn't. You need to analyze your investments and prospective investments and invest with a purpose and the specific return in mind if you're going to go into the world of investment seriously in the process. So the language of investment, here are some of the basic elements. Know them because we'll be talking about here in the whole rest of this course. But also, if you're serious about investment, this will be the jargon you have to get used to in the process to make certain you develop your portfolio and can speak the same language. Take care.